Does the Palantir management team think the stock is too expensive? That's the question I'm going to answer in this video, looking at several factors, including the company's share buyback program, the forward price to earnings valuation, the company's performance on operating cash flow and return on investor capital, to try and decipher whether or not the management team believes that these shares are overvalued at current market prices. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so I've been digging through the company's financial statements, and for the quarter that ended March 31st, 2025, the company had no outstanding debt or zero debt, and it had over $5.4 billion in cash and equivalents on the balance sheet. So an absolutely pristine balance sheet, very strong cash balance, zero debt. The company's cash flow from operations are solidly positive. And so no financial trouble. In fact, I would say the company has too much cash. If investors had a complaint, they would complain and say, why doesn't the company put more of its cash to work instead of sitting on such a large balance? In August of 2023, the board of directors authorized the stock repurchase program of up to $1 billion. During the 3 months ended March 31st, 2025, the company repurchased and retired 200,000 shares of its Class A common stock for an aggregate amount of $18 million. So they could have bought up to $1 billion of their shares, but they only bought 18 million. Overall, as of March 31st, 2025, the company has $918 million of that $1 billion authorization remaining. So since August of 2023, they've had the option, they've approved themselves for the option to buy back shares, spending as much as $1 billion. They've only spent about $82 million out of the $1 billion. So less than 10% of the approval they've actually utilized to buy back their stock. And usually when a management team is buying back their stock, it's a sign that they think their shares are undervalued. Sometimes it could mean that they don't have any growth opportunities and they don't have any other way to spend the capital, and so they buy back their shares. But for most times, they feel that the shares are undervalued if they buy back their stock. Because if they really wanted to return capital to shareholders, there are other options instead of buying back stock. They could, for instance, announce a special dividend payment. They could announce a regular dividend payment, an increasing dividend payment. But when the company chooses to buy back the stock, it's a sign that they think the shares are undervalued and they feel like it's a good use of the company's capital to buy back the shares because it reduces the total shares outstanding, which then makes the earnings per share increase because you're splitting the net profits of the company among fewer shares and thereby increasing the earnings per share. So it has a lot of benefits, and managements worldwide do this. This is a popular way to spend capital, especially for businesses that haven't started paying a dividend yet, because a dividend is more of a permanent thing. When a company starts paying a dividend, investors expect that dividend to continue almost forever. And so when a business starts paying a dividend, they will only do that if they feel extremely confident that they can continue paying that dividend and in fact increasing that dividend for the very, very long term. Businesses are more hesitant to start a dividend than they are to start a share buyback program. So Palantir stock is now trading at a forward price to earnings of almost 200. It's 199.76 to be precise. It's one of the most expensive companies, looking at it from this valuation metric, for a company that's been around for as long as it's been around. It's been around for about 20 years. And it's trading at very high valuations according to the forward price to earnings ratio. In fact, if you go all the way back to January, this is about the highest it's been, trading at in terms of the forward price to earnings. It's near the peak levels. It was up as high as 210. That's about the highest it's been. And then if I go back longer, the forward price to earnings, you were able to get this company at a forward PE of between 50 and 60 for, you know, a while there before the company's revenue started surging and accelerating as a result of the very successful launch of its AIP products. And so the company's operating cash flow to sales has increased meaningfully up to 43%, which is an excellent OCF to sales number. The return on invested capital increased up from negative levels all the way up over 39.8% in the most recent trailing 12-month period. So the business deserves that super premium valuation, but maybe not as high as 200, right? That's what management might be thinking is this valuation seems a bit stretched. And I've done a proprietary discounted cash flow model for Palantir, and this number has kept increasing all year. The intrinsic value per share I've calculated for Palantir is now at $29.83, which is much higher than where it was to begin 2025. So this number has kept increasing, but so has the current market price. The current market price is now $123 a share. It's very close to the 52-week high of $123. The 52-week low was just $20.64. So the stock price has soared off of its 52-week low. In fact, if we look at the business on a trailing 12-month price to earnings basis, it's trading at a trailing 12-month PE ratio of 536. So in almost every valuation metric I look at, Palantir stock looks very expensive, but at the same time, it's an excellent business with very strong prospects in the years ahead. I shared with you very important financial metrics like the OCF to sales, like the ROIC to the increases in ROIC. And so this business deserves a premium valuation, a super premium valuation, but I think it's still stretched at current market prices. Even though it's an absolutely excellent business, I have it on my watch list. I'm ready to buy this stock. If I can get it at a more attractive valuation, I'm ready to buy this stock. But I don't know if I'm going to be able to buy it at a more attractive price because the business is no secret to stock market investors. It's one of the most popular AI stocks in the market right now. And so everyone knows what a great business this is, and they've jumped ahead and bought this stock. They've set aside valuation concerns and they've just said, look, let's just buy this stock. Let's not miss out on this great company because of valuation concerns. It's okay if we pay a little bit of an expensive price. We just want to own this business. And so management is being a little more prudent and they're not utilizing their share buyback. But I think it's still great that they have that. They have that capacity available just in case if there's a drop, right? If there's a big drop in the current market price, let's say it falls to $80 a share or $70 a share, then I think management will step in and start buying back more shares more aggressively at those lower prices. So even though management might think that the shares are overvalued right now, the fact that they have that buyback authorization provides, in my opinion, a little bit of a safety on the shares crashing by too much. Because if it does fall by too much, let's say it falls to 60, $70 per share, I think management will step in aggressively and buy back the shares and thereby stop it from falling much further. Now, it still could fall much further if there's a big decline in investor sentiment and there's a big decline in the interest in these kinds of growth stocks, then there is still a risk that it can fall further. But with $1 billion or a little over $915 million remaining in their buyback authorization, management can step in and buy back these shares. So these charts, by the way, I'm getting from FinChat.io. There's a link in the description for a discount if you're interested in doing research using these charts. I use them all the time. And the forward PE ratio, if the stock price were to fall, let's say to $60, the forward PE would still be around 100. So it's not like it would be a really cheap stock. It would still be an expensive stock, but it would be less expensive than it is, half as expensive as it is today. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.